The Buffett Indicator, often hailed as the Oracle of Omaha, Buffett's investment strategies are remarkably successful and have captivated millions worldwide. Whether you're a seasoned trader or a beginner seeking financial wisdom, this indicator helps you navigate the ever-changing landscapes of the stock market. Hello and welcome to our YouTube channel. Today, we're going to talk about the Buffett Indicator, understanding Warren Buffett's favorite market indicator, so let's dive into the details. Before we embark on our journey into the depth of the Buffett Indicator, let's briefly introduce the man himself, Warren Buffett. Buffett, who was born in 1930, developed an interest in business and investment at a young age. He eventually became widely regarded as one of the industry's most prosperous and individual figures. Over the years, he built a tremendous fortune by turning Berkshire Hathaway from a failing textile company into a powerhouse conglomerate. To understand this famous indicator, we need to go back in time to the early 20th century when an economist named John Burr Williams laid the groundwork for valuing assets based on their present value of future cash flows. He had no idea that his contributions would form the foundation on which Warren Buffett's legendary investment career would be built. Williams first proposed the discounted cash flow (DCF) model, which is used to calculate the present value of cash flows expected from an investment in the future. Buffett liked the notion and realized it might be a useful market signal. On December 10, 2001, Buffett and journalist Carol Loomis penned a powerful editorial for Fortune. The seminal paper by Buffett featured an engrossing graphic covering 80 years and showing the value of all U.S. publicly traded equities as a percentage of GNP. It all came together for Buffett, and he named it the Buffett Indicator. He claimed it to be the most accurate gauge of current market trends and values. And what do you know? It worked remarkably well in identifying future market movements. In his essay, Buffett argued that the market would soar uncontrollably if the annual return of U.S. securities vastly exceeded the annual increase of U.S. GNP for an extended period. What, therefore, does the Buffett Indicator mean? This metric is based on a comparison of the value of the stock market as a whole to the GDP of the country. To what extent the market is over or undervalued is shown. When the ratio of market capitalization to GDP is high, investors may want to be cautious because it suggests the market may be overvalued and on the verge of a correction. Conversely, if the ratio is low, it might be a good opportunity to invest because the market is cheap. The strength of the Buffett Indicator is that it provides useful information on the state of the stock market. It's been discussed extensively in the financial press and is now included in many introductory textbooks on finance. The Buffett Indicator was named by Wall Street Journal contributor and finance expert Mark Holbert as one of the 8 best predictors of the long-term market. This indicator has proven its worth, predicting the long-term directions of markets time and time again. Still, there's more to come. The scope of the Buffett Indicator is not limited to the USA alone. 2 European researchers published a study in May 2022 that looked at its effects on 14 developed markets using data from as far back as 1973. Amazingly, the Buffett Indicator was able to account for an average of 83% of gains across all countries and time periods. Speculate on that. It served as a lighthouse, pointing the way for potential investors. There was a wide range of accuracy from 42% to 93% depending on the size of the stock market in each country. The question now is, having identified the genius underlying the Buffett Indicator, how can you incorporate it into your investment strategy? First and foremost, keep in mind that there is no cookie-cutter method to investing. Although the Buffett Indicator can be a helpful tool, it's essential to use it in conjunction with other indicators and do extensive research prior to making any decisions. The ratio may be favorable for stock investments if it drops to 70 to 80 or a lower level. On the other hand, if it starts to get close to 200% as it did in the infamous dot-com boom of 1999, alarm bells should start to ring because it could mean that you're playing with fire. It's true that the Buffett Indicator is a useful tool, but it's also vital to remember that no single indicator can capture the whole health and relative value of the market. Several arguments against it highlight its shortcomings. The indicator's singular emphasis on stock market value to the exclusion of other asset classes like bonds is a major point of criticism. Bonds with greater returns become more attractive to investors when high interest rates occur, causing a decline in demand in stock prices. Instead, bond yields falling due to low interest rates boost stock values by increasing investor demand. Historical data shows that the 10-year U.S. Treasury bond rate was relatively high throughout the peak of the dot-com bubble, indicating that low interest rates were not the primary force behind the inflated stock market. At its current level of 3.84%, the Buffett Indicator suggests that investors are looking to equities and other high-risk investments to compensate for low bond yields. Another argument against GDP is that it doesn't properly reflect the effect that overseas operations have on the value of the stock market. Companies like Amazon, which do well worldwide and whose stock is traded on the U.S. stock market, see a major portion of their revenue come from outside the country. The GDP numbers in the U.S. don't account for all of this money, though. The expansion of the Buffett Indicator may be traced back to the positive effects of globalization on the market valuation of U.S.-based companies, which have benefited from increased exports in recent years. However, in the suggested valuation approach, the indicator is evaluated in relation to its own exponential growth trend line. The Buffett Indicator is expected to improve as a result of developments in technology, rising demand from outside, and the developments of new markets. How can you, as an investor, actually put the Buffett Indicator to work for you? Well, here is some advice for you on how to use this signal effectively in your portfolio. Never make an investment decision without first combining multiple signs and conducting extensive study. Now, let's look at some historical instances of the Buffett Indicator in action to further cement our understanding. We will examine both the times when the indicator correctly forecasted market developments and the times when it may have given false alarms. Using the Buffett Indicator to assess the state of the stock market and its relative valuation is a strong and insightful endeavor. However, it includes caveats just like any other measure. We should be cautious and take into account a variety of elements when making investment decisions, as the criticism surrounding its singular emphasis on stock market value and its absence on the influence of foreign operations serve as a reminder. When bond yields change, investors search for opportunities to profit from the shift in the stock market. Another valid criticism is that the indicator does not completely account for the effect of overseas sales on stock market valuation. However, by incorporating the indicator's own trend line onto the evaluation model, we are able to evaluate market movements with a more nuanced viewpoint. Investors can make better decisions in the ever-changing financial market if they take these critiques into account, along with other pertinent measures and aspects. In the end, the Buffett Indicator is helpful, but it's most effective when utilized in conjunction with a well-rounded strategy. Let us keep Warren Buffett's timeless advice in mind as we delve deeper into the complexities of the financial sector. Effective investment requires a blend of knowledge, patience, and a long-term outlook. Let your investments prosper. So, that's a wrap on this video. I hope you liked it. If you did, please give it a thumbs up and don't forget to subscribe to the channel. Thank you for watching. See you next time.